Good evening, all students.
Good evening.
Today we have to start new unit, that is unit 4, risk management for enterprise. Let student to join these sessions. Okay, let's start. Concept, scope, enterprise risk, approaches for corporate risk management, ERM, enterprise risk management. Concept of risk management, meaning of risk. Risk is possibility of loss, uncertainty in achieving organizational objectives due to internal or external factors. Risk arises because of uncertainty in future outcomes, market volatility, operational failures, legal and regulatory changes, financial instability. Enterprise risk management (ERM) is a strategic term used by organizations to identify, assess, and prepare for potential dangers, hazards, and opportunities that may interfere with their goal. Unlike traditional risk management, which often handles risk in silos like IT focusing only on cyber or HR focusing only on safety. Everyone's focus may be on their goal. ERM looks at the entire portfolio of risk across the entire to see how they interconnect. It enhancing shareholders' wealth by better managing business risk prepared by Price Waterhouse Coopers on behalf of International Federation of Accounts covers best practices and current thoughts leadership with regard to risk management. The central thesis of the paper is that sustainable growth in shareholder value is inextricably linked to risk, which requires response, which in turn drives value. Companies must understand what the drivers of value are and what are the key risks associated with them. The answer to these questions can be formulated by mapping the process that drive value within the organizations and by identifying and analyzing the business risk and establishing the appropriate responses that will have maximum impact on the value drivers. Risk identification and definition should be approached in a systematic way. Organization must develop a sound understanding of the strategic and operational objectives of the organization, including critical success factors and the opportunities and threats related to the achievement of these objectives. Organizations must also analyze the functions under within the organizations to identify the significant risk which flow from these activities. Once risks have been identified, an assessment of possible impact and corresponding likelihood of occurrence must be made using consistent parameters. Risk maps or risk metrics are a simple yet powerful way of displaying the relationship between likelihood and impact for the key identified risks, thus providing both measurement and reporting of the risk profile. All companies face threats in the current dynamic environment: new competition, new technology, changes in consumer taste, and so on. But only a few of them manage these risks effectively. Those who do so are alert to changes in the environment and are willing to change internally to respond to them. This is the main point which drives home in his sessions. Strategic planning and risk management. The session discusses how risk must be dealt with formulating and implementing strategy. A brief overview of the tools and techniques available for strategic planners is also provided. Strategic planning plays the crucial role of enabling a company to anticipate and deal with risk efficiently. Strategic planning is all about positioning an organization to take full advantages of opportunities in the environment while simultaneously reducing its vulnerability to threats. Thus, good strategic planning implies the ability to digest what is happening in the environment and reshape the organizations accordingly. It becomes easier to do this if an organization is prepared for various eventualities. Then, as events unfold in the environment, it is in a better position to decide which strategy would work best. Straight-jacketed thinking, on the other hand, makes the employees of an organization impervious to external developments. When changes do occur, they are taken by surprise. By short, being open to various possibilities and examining the possible course of actions for each of them. Strategic planning can, to a large extent, keep risk within manageable limits. Many companies get into problems because their leaders fail to address an important questions. What happens if we are wrong? So when you will be a manager of your organization, you must have to think about these questions. What happens if we are wrong? Okay, it's a part of our management. In other words, they badly misjudge the risk inherent in their decisions. Scenario planning is a useful tool for companies to manage risk. In this session, the official future, self delusion, and the value of scenarios. Peter was explained that there are two very different types of scenario planning. One is exploratory, trying to understand the contours of an unknown landscape, the future, mainly out of a general sense of interest. And exploratory approach may be helpful in seeking out potentially unforeseen risk. The second class of scenarios that relating to decision making help achieve a better understanding and management of risk. Decision makers evaluate risk in situations of great uncertainty, largely by engaging in collective self delusion. They start out with a preferred scenario, the conventional wisdom, the accepted view, or the official future. There are five questions which a decision maker should raise to examine whether their preferred scenarios is appropriate. If they could speak with an oracle, what questions would they ask about the future? Given the decision to face, what is the scenario for the best possible outcome? Second, what is the scenario for the worst possible outcome if they were retiring or leaving the company? Third, what would they want their erstwhile colleagues to consider as their legacy? And finally, are there important barriers to change in the organization? Scenarios not only facilitate better decision making, but also lead to gradual changes in the perceptual models of the decision makers themselves. Decision maker can reconstruct their perceptions and change their minds and ultimately change their agenda even as they go forward. Real option let the buyer beware. Jeffrey J. Russer and Michael J. Lebrin explain the use of real options in risk management. The concept of real options applies the techniques developed in financial options theory to the analysis of non-financial real assets. Real options are valuable as they confer the right but not the obligation to take some actions in future. The real options approach emphasizes that many investment create important follow-on opportunities that a company may or may not subsequently exploit. Consequently, the real option approach highlights value that is contingent on earlier investments. Real options come into existence as a result of the company's strategic investments because their underlying assets do not trade in liquid markets. Real options also present unique valuation challenges. The real options perspective has significant implications for the conception and implementations of strategy and risk management. Real options analysis encourages executives to confront fundamental sources of uncertainty proactively rather than merely attempting to buffer against or avoid uncertainties. For example, real options analysis encourages managers to create value and reduce risk by making strategic investment that confer claims on potentially lucrative opportunities, actively monitoring various sources of uncertainty and changing resources allocations appropriately in real time. Real options come in handy when the markets for financial options are incomplete. A good example is uncertainty relating to a technology. A second related consideration is the desired time horizon for risk protections, while financial option provide cover against uncertainties for relatively short periods, typically less than several months. Many uncertainties to which a company is exposed are resolved only after more lengthy time intervals. The session provides several illustrations of real options, investments in geographically dispersed foreign subsidiaries, confer the options to switch activities across borders in response to changes in currency markets, factor markets, or product markets. This option is likely to be particularly valuable when there are changes in local demand, labor expenses, other input costs, competitors' actions, or foreign exchange rates, all of which may vary from country to country. Similarly, international joint ventures enhance flexibility and reduce risk. A company can reduce its inherent liability of uh, forgiveness, its lack of local knowledge, network, familiarity with the business customs, and so on. By taking on a local partner, the company can also tap into the unique skills of a collaborator to shore up weaknesses in its own capability base. Income stream risk can be reduced during the course of the joint venture by sharing equity. Finally, a risk associated with making heavy initial resources commitment in uncertain industries can be mitigated by expanding sequentiality. For instance, if a company has the right but not the obligation to buy out its partner, the company will go ahead and expand through acquisition. If at some point in future the value of the part of the joint venture it does not already own exceeds the buyout's price. In this session, value creation through real option in management by Marcel Bayer, Peter Christopher, Piers Lasser, and Andrew Paulo explain the flexibility created by the real options approach to management. They point out that the value of a real options increases with uncertainty, but unfortunately, many companies do not appreciate the value of options embedded in their investment. The building blocks of the real option approach are uncertainty creates opportunities and value. Value creation requires certain decisions to be taken. Sources of uncertainty must be identified and necessary information should be collected. Decisions that promote exposure to favorable outcomes must be identified. Decisions that reduce exposure to downside risk must be identified, and optimum decision rules must be established. In this session, tooling up for risky decisions, Kyrios Vlaos points out that betting on a single view of the future is always risky. Tools such as decision analysis, real options, and scenarios planning can be used for profitability in situation of uncertainty. Option theory is useful when market information is available, when coping with private risk, which cannot be hedged in financial markets. Decision analysis is preferable. Decision analysis has the following building blocks: visual tools for structuring multi-stage decision problems, probability theory for modeling uncertainty, utility theory for modeling risk preferences, extension to decision problem with multiple conflicting objectives. Until recently, risk has been viewed by business as a negative concept. However, CEOs have recognized that manager risk is an integral part of generating sustainable shareholder value. This positive interpretation of risk reflects the new understanding of the connection between well managed risk and improved performance. Effective risk management practices can identify and evaluate risk across all levels of the continuum and can deliver realistic assessment of the likelihood and impact of risk on the organization's value. In this session, it covers some of the leading edge issues that provide practical guidance on the best practice and convey current through leadership in regard to the risk management. Why is there such interest in risk management? Until recently, risk has been viewed by business as a negative concept, a hazard or downside. However, CEOs have recognized that managing risk is an integral part of generating sustainable shareholder value. This positive interpretation of risk reflects the new understanding of the connections between well managed risk and improved performance. That is where management mobilize the linkage between risk management, achievement of corporate goals, and reduced volatility of outcomes. The organization's economic performance can be enhanced significantly. There is a punchline of a cold drink that is Mountain Dew. And what is the punchline? डर के आगे जीत है. Means every CEO and manager must have to face the situations and they should have to be prepared to face every risk, and everyone know when you are to generate maximum profit, you must have to enter in the field of risk. Risk means maximum profit or it may be maximum loss. But there are two sides of one coin. Okay, that may be positive response or that may be negative response. Okay, it is totally depend upon our management and policies. Okay, so the punchline डर के आगे जीत है made by a woman and a media agency woman has earned 1 crore rupees of this punchline. This information only for all because you should know every organization has their punchline. Just like we have to set mission and vision statement of our organizations, and punchlines indicates the perfect meaning of the production system and the mentality and profile of the company. Okay, so you can be enter in the field of to make these types of lines. Understanding the organization risk profile. The risk faced by organizations are part of risk continuum. They are be evaluated in terms of hazard, uncertainty, and opportunity, and by the degree of influence they have on performance, operating performance, and strategic objectives. Effective risk management practices can identify and evaluate risk across all levels of the continuum and can deliver realistic assessment of the likelihood and impact of risk on the organization's value. Risk response or architecture. Risk response or architecture ensure that a resource allocations responds to the continuum of risk faced by the organizations. For its success, the responses are architecture is reliant upon gaining commitment from executive management and the board of directors, establishing the business process, including assigning responsibilities for change, resourcing, communications, training, and reinforcing a risk culture throughout the organizations via human resource mechanism. Future developments, new international expectations, and in some cases, standard are emerging and additional tools and techniques are becoming available for better measurement of risk and value. Why is there such interest in risk management? Because risk management is integral to sustainable shareholder value creation. Investor, director, managers, and regulators on both the government and private sectors around the globe are expanding the breadth and depth of their interest in risk. The work done over the last decade on control frameworks has built a platform from which enlightened management can now see the full perspective of risk management, establishes, calibrates, and realigns the relationship between risk, growth, and return. The central thesis of this session is that sustainable growth in shareholder value is inextricably linked to risk, which requires response, which in turn drives value. It is an interactive process. The following illustration depicts the integrated relationship of creating and delivering sustainable shareholder value. The business risk continuum, the risk response or architecture, the combination of identifying and measuring the risk continuum plus the risk responses produces risk management. What is risk? Uncertainty in achieving objectives. Risks are uncertain future events which could influence the achievement of the organization's strategic, operational, and financial objectives. The dimension of risk include the impact on an organization's reputation, even the loss of legitimacy from activity deemed unacceptable to the community. Risk management is conformance and performance. Directors continues to ask management and consultant the questions, where is the organizational exposure? This arises from the ongoing conformance burden of corporate governance. On the other hand, the less frequently asked questions are, we taking enough risk? Reflect a healthy focus on performance improvement. Risk management is thus an adhesive that joins performance with conformance. Global executives are launching major initiatives to improve their company's management of risk to drive performance. These initiatives focus on actively managing risks that must be taken in the pursuit of opportunities and ultimately profit. This new look as risk contrast with the more common notation of risk management, which has concentrated on protecting the organizations from losses through conformance procedures and hedging techniques. Such risk management tactics seeks only to avoid the downside of financial loss. Today, boards expect that management will look at both risk assessment, undertaking the potential upside and downside of actions, and the management of the risk to raise likelihood of success, reduce the likelihood of failure, and decrease the uncertainty of overall financial performance. Risk management in a full sense is about seeking the upside while managing the downside. On the former, seeking the upside, risk is inherent in business. Although the nature and extent may differ, risk is as applicable to a smaller retailer as it is to a multinational conglomerate. A company takes risk in order to pursue opportunities to earn returns for its owners. Striking a balance between risk and return is key to maximizing shareholders' wealth, while the latter managing the downside requires a combination of conformance and performance. Risk regulations relate directly to the management of the balance sheet, to market risk and credit risk, and are detailed in the corresponding sections of this text. The accounting standards segregate instruments into four cases differing by valuation and treatment of profits and losses. That are financial assets at fair value, though profit and loss, loans and receivables, held to maturity investments available for sell financial assets. The financial assets at fair value include all instruments acquiring to take advantages of price fluctuations and are managed with the intention of making short-term profits, the performance of which evaluated on a fair value basis. Derivatives are held for trading unless they are considered as hedges. The assets and liabilities of the trading book are under this category. Fair value focuses on the price at which an asset can be sold. It is the amount at which an asset could be exchanged between parties knowledgeable and willing to exchange. Valuation depends on whether markets are active or not. Active markets are those where the volume of transactions provide clear prices. For other instruments, prices can be derived from other traded instruments in active market, or valuation is model based. Accordingly, market instruments fall in either one of three categories. Level 1, when quoted prices are available. Level 2, when there are market prices for similar instruments. And level 3, for model valuation for instruments that are not extensive traded but have a value derived from models or mark to model, such as option traded over the counter. Model valuation is recognized as a fair value in the absence of the active market. Loans and receivables are instruments with contractual payments and are not quoted in active markets. These assets are held in the banking book. In the banking book, income is determined according to accrual accounting rules of revenues and cost. Held to maturity instruments are financial assets with contractual payments for which the management intention is not trading. Investment portfolios of banks group financial assets such as bonds in which bank invest for the long term with no trading intent are in this category. All other assets are available for sale. Risk management requires that the risk of a financial institution be identified, assessed, and controlled. Enterprise risk management addresses a combination of credit risk, market risk, interest rate risk, liquidity risk, and operational risk. Sound risk practices define who should be accountable for this risk and how the risk process should be implemented. Motivations. There are strong reasons motivating the sound assessment and management of risk in decision making processes other than compliance with risk regulations. Risk and return are two sides of the same coin. It is always easy to lend and to obtain attractive revenues from risky borrowers. The price to pay is a higher risk than the prudent bank and higher potential losses. The prudent bank limits risk by restricting business volume and screening out risky borrowers. It saves potential losses but might suffer from lower market shares and lower revenues. However, after a while, careless risk takers find out that higher loss materialized and could end up with a lower performance than the prudent lender. Banks that do not differentiate risk of their customers would suffer from adverse economics. Overpricing a good risk would discourage good customers. Underpricing bad risk would attract bad customers, discouraging the relatively good clients and attracting the relatively bad ones would result in adverse selections. Means you cannot increase the cost of your product or you cannot decrease the cost of your product. If you will increase the cost of your product, customer will think to buy your product or not, or to avail other options in the market. And if you are selling that product in low rates, means bad customers will be attract, okay, which will down the image of the company. The risk processes. Risk processes include the identification, monitoring, and control of risk. Risk model serves for measuring and quantifying risk and provide the inputs for the management processes and decisions. To be effective, they should be implemented within a dedicated organizational framework that should be enterprise wide. All risk processes imply that risk policies be properly defined and that the risk appetite of the firm be well defined. Within this framework, the common process for controlling risk is based on risk limits and risk delegations. Limits impose upper bounds to the potential loss of transactions or of portfolios of transactions. Delegations serve for decentralizing the risk decisions within limits. Limits aims at avoiding that adverse events affecting transactions or a portfolio of transactions impair the credit standing of the firm. Banks need to segment their activities into meaningful portfolio. For example, by business unit, product or type of clients, limits of exposure are set for each segment and down to transactions, forming a hierarchy of limits and submits for credit risk limits set by segment, then by counterparty, and then by individual transactions. For market risk, limit can be set for specific books of trades, then desks, and then trades. Delegations and authorizations to act and take risk on behalf of the organization. Delegations decentralize and simplify the risk process. by allowing local managers to make decisions without referring to the upper levels of the organizations within the scope of their delegations. For example, they simplify the risk process for transactions that are small enough to be dealt with by local procedures. Credit risk limit and delegations. Any limit system requires one or several measures of risk used for determining whether or not a transactions or a portfolio of transactions complies with limits. Various risk metrics are used for setting limits for credit risk. The amount at risk or exposure is a simple measure of the amount that could be lost in the event of default of the borrower. Other metrics captures other dimensions of credit risk. For example, trades might be allowed by only for eligible borrowers based on their credit quality, or limits can be applied to regulatory capital for credit risk, which combines various components of credit risk, exposure, loss after recoveries, and credit quality. Credit limit systems are based on common criteria. For example, diversify the commitment across various dimensions such as customers, industries, and regions. Avoid lending to any borrower an amount that would increase its debt beyond its borrowing capacity. The equity of the borrower set up some reasonable limit to its debt given acceptable levels of debt or equity ratios and repayment ability. Set up a maximum risk level, for example, defined by the credit standing of borrowers above which lending is prohibited. Ensure a minimum diversification across counterparties and avoid concentration of risk on a single borrower, an industry, or a region. For being comprehensive and consistent, the limit system has to, to be bank wide. Global limit system aggregate all risk on any single counterparty, no matter which business unit initiates the risk across all transactions with the bank. Global limits are broken down into sublimits. Sublimits might exist even at the level of a single client. The total usage of sublimit should not exceed the global limit assigned to each counterparty or portfolio of transactions. Limit system allow sublimits to sum up to more than the global limit because not all sublimits are fully used simultaneously, but the aggregated risk should comply with the global limit. For example, multiple currency facilities are convenient for clients because they allow raising funds in several currencies and as needed. But a currency client should not use more than its global limit. Utilizations are bounded by either sublimits or global limits, whichever it is hit first. Any excess limit has to be corrected by not entering into a new transactions or mitigating the risk with guarantees. Some limits might be hit while others are not. Bank system address the issue with access limits, report showing which transaction hits which limits. Credit approval processes vary across banks and across types of transactions. In retail banking, the process relies on procedures that need to accommodate a large volume of transactions. Time consuming processes are not applicable for the retail portfolio because of the high number of transactions. Instead, credit scoring mechanism and delegations are used within the guidelines of the credit policy. In normal circumstances, the credit officer in charge of the client of the brand is authorized to make decisions as long as they comply with the guidelines. For large transaction, the process involves credit committees. Credit committees brings together the business line, the risk managers, and the general management. The business line proposes new transactions together with a risk analysis, and the committee reviews the deal. Committee need to reach a minimal agreement between members before authorizing a credit decision by examining in detail significant credit applications. The committee makes a yes or no decision or might issue recommendations for altering the proposed transaction until it complies with risk standard. Collateral third-party guarantees or contractual clause mitigate the risk. The alternate process is through signatures, whereby the transaction proposal is circulated and approval requires agreement between all credit officers. Whether signature or committee are used for approval, risk officers remains accountable for the risk decisions and decisions are recorded eventually with comments and recommendations of participating executives. Meaning of risk management. Risk management is a systematic process of identifying, analyzing, evaluating, and controlling risk to minimize losses and maximize opportunities. Definition we have already seen. Objectives of risk management that are ensure business continuity, protect assets and resources, reduces uncertainty, improves decision making, stabilize the earnings, enhance shareholders value, complies with law and regulations. Scope of enterprise risk management, ERM. The scope of ERM is enterprise wide, covering all departments and levels of management. Areas covered under ERM: first, strategic risk, competition, technological changes, market demand changes, business model failure, financial risk, credit risk, market risk, liquidity risk, interest rate risk, currency risk, operational risk, process failures, human errors, system breakdown, supply chain disruptions. For legal and compliance risk, that are regulatory changes, contract risk, litigations, tax issues, reputation risk, brand image damage, customer dissatisfactions, media exposure, environmental and social risk, natural disaster, climate risk, CSR issues, corporate social responsibility, enterprise risk, meaning and features. Meaning of enterprise risk. Enterprise risk refers to any risk that affects the achievement of organizational objectives across the entire enterprise rather than isolated departments. Features of enterprise risk that are organization-wide impact in encountered risk, both downside and upside risk, dynamic and evolving, affects strategic goals, requires top management involvement. Types of enterprise risk, category given and examples. Strategic risk, wrong business strategy, mergers, failures. Financial risk, credit risk, interest rate risk. Operational risk, IT failure or fraud. compliance risk, low violations, penalties, reputational risk, brand damaging. Approaches for corporate risk management. Corporate risk can be managed through traditional and modern ERM based approaches. Traditional risk management approach. This approach manages risk in silos separately. Characteristics department wise risk handling focus mainly on insurable risk, reactive approach, little coordinations, no link with strategy, tool used insurance, safety programs, loss prevention, hedging. Limitations ignores independence of risk, not proactive, limited to operational and financial risk. B. Enterprise risk management approach. ERM is an integrated and holistic approach to managing all risks across the organizations. Characteristics, enterprise-wide view, linked with business strategy, proactive and continuous, top management driven, risk-aware culture, benefits, better risk identifications, improves corporate governance, effective resource allocation, enhanced shareholder value, regulatory compliance. Enterprise risk management, detailed definition of ERM. Enterprise risk management is a structure, consistent, and continuous process across the whole organization for identifying, assessing, responding to, and reporting risk that affects the achievement of objective. ERM process or frameworks. ERM follows a systematic process, risk identification, identifying all possible risks, strategic, financial, operational, legal, environmental, and techniques used to overcome all these types of risks. That's our brainstorming, risk workshop, SWOT analysis, strength, weaknesses, opportunities, and threats, checklist, past lost data, scenario analysis, risk assessment measurement, analyzing risk based on probability of occurrence, impact, or severity. Methods, qualitative, low, medium, high, quantitative, VAR, value at risk, stress testing, risk matrix, sensitive analysis, risk prioritizations, ranking risk according to importance, high impact, high probability, low impact, low probability, focus resources on critical risks, risk response, risk treatment for main strategies, risk avoidance, eliminate activity causing risk reduction, mitigate internal controls, diversification, safety measures, risk transfer means insurance, outsourcing, hedging, derivatives, risk acceptance, retentions when cost of control benefit, risk monitoring and review, continuous tracking, periodic audits, key risk indicator KRIs, internal reporting, risk reporting and communications, risk dashboards, risk registers, management reports, board level risk committee. I have already told you to all students that you should be able in Excel to create your own dashboard to show the overall situations of your organizations at the time of board meeting. COSO ERM framework. COSO ERM has 8 components. The COSO ERM frameworks, Committee of Sponsoring Organizations of the Tradeway Commission is the gold standard for managing risk in the corporate world. While the original 2004 version focused heavily on internal controls, the updated 2017 version titled Enterprise Risk Management integrating with strategy and performance shifted the focus towards how risk management creates and preserves value. COSO IRAM has eight components: internal environment, objective setting, event identification, risk assessment, risk response, control activities, information and communication, eight monitoring. The five components of COSO ERM, that's the framework is organized into five interrelated components, often visualizations as a ribbon flowing through the business cycle. That's our first, governance and culture. This is the tone at the top. It's about ensuring that the board and management understand the importance of ERM and that the company's culture encourages ethical behavior and risk awareness. Exercise oversights means, does the board know what the risks are? Second, establishes operating structures, means how is the risk team organized? And third, attracts the retains capable individuals, hiring people who understand the mission. Second frameworks, that is strategy and objective setting. ERM isn't something you do after you set your goals. It happens while you set them. Risk and strategy are two sides of the same coin. Analyzes business context, means what's happening in the world around us. Another defines risk appetites, means how much skin in the game are we comfortable with. And another evaluates alternative strategy, means what happens to our risk profile if we choose path A instead of path B, just like plan A and plan B. Third framework, that is performance. This is the meat of the process, identifying and assessing risk that could prevent the organizations from hitting its targets. That's our identifies risk, means spotting the hurdles. Another assesses severity of risk, means using heat maps or impact likelihood scales. Heat map I have already shown you in our first sessions. Prioritize risk data. You can not fix everything at once. Focus on the big ones. And last, implements risk responses, means decide whether to accept, avoid, reduce, or share. For framework, review and revision. The world changes quickly. These components ensures the organization looks back to see how well its risk management performed. Fifth, information, communication, and reporting. This is the plumbing of the system. It ensures that data flows up, down, and across the company. Advantages of enterprise risk management. Integrated risk view reduces surprise and losses, improves strategic planning, enhances corporate governance, improves investor confidence, optimizes risk return trade off, business sustainability. Limitations, challenges of ERM, that are high implementation cost, resistance to change, data limitations, cultural barriers, lack of skilled professionals, complexity in large organizations. 10. Difference between traditional RM and ERM. Traditional RM and ERM. Fragmented approach, integrated approach. Focus on insurable risk, covers all risks, reactive, proactive, departmental level, enterprise level. No strategic link, linked to strategy. Limited reporting, board level reporting. In this way, RM and ERM is shown traditional and latest. Role of top management in ERM, board of directors set risk appetite, risk committee monitor risk, chief risk officer CRO coordinates, department heads identify risk, employee follow risk culture. And last, enterprise risk management is a strategic management tool that enables organizations to anticipate, manage, and exploit risk effectively. ERM transform risk from a threat into a competitive advantage by integrating risk management with corporate strategy and performance management. Thank you. Today's session is over.